Most banks turn over their balance sheet about every 4 years. If you think about it, Citibank, JP Morgan, a quarter of their assets redeem every year. They got to go replace those. They got to go make a new loan to somebody or go buy a security, right? So when that happens, they're hoping to get a better price than they did 3 and 4 years ago when rates were really low and the Fed was suppressing interest rates. No, not so much. If you look at Citi, for example, the gross spread on their commercial loan book is 1.5%. You might as well not do it. But what that tells you is they don't have any pricing power. JP Morgan is well up into the 2s. Wells Fargo's 3 something. BA's in that same neighborhood. But when you look at the smaller banks, they're up in the 4s. So a large bank that has to make big loans because they have a big balance sheet, it's very competitive. Those banks are out competing with insurance companies and pension funds for assets. Somebody like Mass Mutual, for example, in the commercial real estate market, they are head-to-head with the banks, and they keep the asset. They're very aggressive, very competitive in the commercial real estate space. So the big banks have a problem in a sense that they have to go out and fight over larger assets with the other large players in the industry globally. Not just here in the U.S., but they're in a global market. I don't think you're going to see a lot of lift on the asset side for banks in terms of what they make on assets. And at the same time, the cost of funds is rising. If you look at the last earnings cycle, most of the big players saw their cost of funds up 50, 60% year over year. The earnings on their assets are growing single digits. So you put those two lines together, and what I've told my clients is by the end of the year, the earnings from assets of the banks are going to be less than the cost of funds increase. So the yield curve, or if you will, the net interest income of the banking industry is going to flatten out, and then it's going to start going down next year. That's going to violate the narrative. When we see net interest income going down across the board for the industry because of this normalization by the Fed, that's going to have a big effect. What is driving this, in part, is the fact that the Fed is slowly letting their balance sheet run off. When the Treasury pays the Fed, say a Treasury bond that the Fed owns, right? They pay the Fed back. The Fed's got cash. They put that on their balance sheet. The investor who owned or who wants to buy that bond, the Treasury is immediately going to go out and issue a new piece of paper because they just redeemed the bond that the Fed had, right? What happens? The investor buys that bond, the deposit disappears. So as reserves shrink, as the excess reserves in particular shrink, and they grew enormously when the Fed was out buying securities, you're going to actually shrink the deposit base of the banking system. That makes it very, very competitive for funding.